The Fed's repo volume just surged to levels not seen since 2020. Did something just break in the financial system, or is there no need to panic? Something big just happened in the world of financial plumbing. The Federal Reserve's standing repo facility surged with an $11 billion borrowing spike in a single day. Was this a sign of trouble brewing in the banking system? In this video, we're looking into the data, bank reserves, treasury bill rates, and the yield curve, the Fed's shrinking balance sheet to uncover what drove this event and what it might mean for the future. So we actually just did a video on the 2019 repo rate crisis, which arguably would have been worse than 2008. In 2019, in September of 2019, when the repo rate spiked 900 plus basis points. I will link that at the end. That's more of a deep dive than this will be. But put very briefly, if you haven't seen that, the repo market is a fancy way to describe an overnight loan market. That's really all it is. Generally, this is between two private institutions, a bank, hedge fund, money market fund. They are loaning money to each other on an overnight basis. This is the SOFR market. And generally, it's secured, right, by secured overnight financing rate, is secured by security, it's collateralized. That makes the loan much less risky because there's collateral. There's an actual security that's collateralizing the loan. And here we can see a breakdown of those securities. We can see total securities. We can see 11 billion was what we had 2 days ago. But we can see the components of that overnight loan. It can be, usually it's treasury securities, but it can also be mortgage-backed securities. So it's an overnight loan. That's really all it is. Well, there's an interest rate to that overnight loan. We'll look at that in a second. This is only indicating a volume. And clearly we can see going back to July of 2020, the amount here in this overnight Fed repo, standing repo facility, not seen since 2020. So what's going on? So imagine I'm a bank or a hedge fund, and it's the end of the quarter, it's the end of the first half of the year, and I need cash. I need dollars. There's regulatory requirements, reporting requirements. I need my balance sheet to look good. I need cash. So I go to the repo market, the private repo market, and I say, look, I got all these treasuries. I got all these mortgage-backed securities. Someone take them just for a day, and in exchange, give me some cash. I need dollars. And if there is a shortage of people willing to give me dollars, I'm not out of luck. I can go to the Fed. The Fed is the lender of last resort. They are the US's central bank. I can go to the Fed. They are the lender of last resort, and I can go to them and say, hey, I need cash. Take my treasuries just for a day. I will repay you the loan, tomorrow. The Fed is going to charge me a higher interest rate. And also there's a stigma about having to go to the Fed. Similar to, like, if you imagine a schoolyard, generally kids don't want to bring in the principal, bring in the teacher, bring in their parent. They want to try to handle it themselves, right? You don't want to be that person that brings in the adult. So it's very similar with the Fed. There's a stigma, but also the Fed is going to charge an ever so slightly higher interest rate on that overnight loan that you're trying to do. And here we can see the composition of the usage of this standing repo facility. What we're looking at here is the balance, the volume that is utilized in this Federal Reserve's standing repo facility. We know the volume was $11 billion on June 30th. We can see the composition here. 11.03 billion was in treasury securities. 11.03 billion of treasury securities, US treasuries, were used as the collateral. A small amount was mortgage-backed securities. About 25 million was mortgage-backed securities. So again, remember that in this overnight loan market, it is massive. Here we can see the SOFR. This is the private overnight loan market. The volume just yesterday alone was $2.9 trillion. While most normal people don't they don't think of money as an overnight loan. This is how the financial system works. This is how banks operate, hedge funds, money market funds, right? They all use this overnight repo market. There's a private one, right, which is SOFR. This is generally how it works. They're generally doing SOFR, participating in the private repo market, which is bank to bank, hedge fund to hedge fund. But in extreme circumstances, they will have to go to the Fed, which is what we see here, this $11 billion spike. As you can see, going back all the way to the summer of 2020, there's only one other spike. It's much smaller at the end of quarter three in 2024, when the Fed's repo facility was used for $2.7 billion. What we saw 2 days ago is much larger than that end of quarter three usage of the kind of last resort liquidity operation from the Fed. Generally, it's done in the private market. Here we can see again $2.9 trillion just yesterday alone. And then in white, we see the interest rate that the private market is charging for those overnight loans. And again, it's supply and demand for money itself. If there is a huge amount of demand for dollars, but very little supply, you will see the SOFR rate spike. And we can also visualize this by looking at SOFR relative to Fed funds, which we'll look at in a second here. But when the demand for money exceeds the supply of money, you will see the SOFR rate spike. And as you can see, this is not really that unusual for the SOFR rate to move around, right? Even during times where you never heard about a crisis, you never heard anything, right? The SOFR rate can be spiking to, 5, 10, 15 basis points. It does that. And we can see that even in the past couple months, the SOFR rate has moved around quite a bit. Well, recently the SOFR rate has spiked from 4.2 to 4.44 in about the last week of June. Now, remember, I mentioned June is the 6th month of the year. That's the end of the first half of the year. It's also the end of quarter two. Again, there's reporting requirements, regulatory requirements, balance sheet issues, right? That banks and financial institutions operate on this sort of basis. And so that generally at the end of a quarter, you will see some of these sort of dynamics start to occur, and we'll get into comparing what we saw 2 days ago relative to other quarter end periods. I think that what we saw a couple days ago was actually more noteworthy than the just normal end of quarter sort of thing. And I'll explain that in a second. So here in white, we have that secured overnight funding rate, the price of money in the private overnight loan market relative to Fed funds minus Fed funds. Remember, the Fed funds rate just stays, as we'll see in a later slide, that is just staying flat, right, for the past couple months, past couple meetings. That is staying flat. So when we see SOFR spike, when we see SOFR minus Fed funds spike, what that is indicating is the private repo market, the private market for money itself, is facing a shortage of dollars, is facing a shortage of liquidity. Therefore, there is a higher interest rate to settle an increase in demand for money itself. So the demand for money is outpacing the supply of money. Therefore, SOFR rate spikes. And as the SOFR rate spikes, it moves it above the federal funds rate to some degree. Now, it can also go below the federal funds rate. That's not generally what we've seen. We've seen these spikes here. We can see that the spread between this private overnight loan price of money interest rate, the spread between that and the federal funds rate at the end of June was 11 or 12 basis points. This has happened before. The end of the year last year, and I actually made a post on this at the time for my ex, but we can see that SOFR Fed funds spiked to 20 basis points. We can see that at the end of quarter three of last year, it spiked even higher. It spiked to like 22 basis points. Now, of course, in 2019, September 2019, repo rate spiked. It moved even higher than this is indicating on an intraday basis. It went to 900. It spiked by 900 something basis points. Just to put it in a context of what we're kind of looking at, this is nowhere near that. It is notable, and there is something here, I think, which we'll talk about in a second. But what this is indicating is the demand for money in the private money market, which is the SOFR market. The demand for money itself is outpacing the supply. Therefore, the SOFR rate goes higher. Therefore, it moves this white line up above the federal funds rate. This number goes more positive, indicating that the SOFR rate is higher than the federal funds rate. You can also see it go negative, which is basically just indicating a kind of the inverse. So why is this happening? Why is there a shortage of liquidity? Well, just like the 2019 repo rate crisis was preceded by quantitative tightening, right? Remember, with QE, quantitative easing, the Fed is printing bank reserves out of thin air, money printing, you can call it, right? They are depositing those bank reserves into accounts at the Fed. But wait, it's not actually money printing, it's more of an asset swap because in exchange, they're giving the banks cash that they just created, dollars, but in exchange, the banks are giving them securities like mortgage backed securities, US treasuries. And so we see the Fed balance sheet during QE move higher. This is because they are getting something in return for those dollars that they are giving to the banks. It's an asset swap. It's not really money printing. And just as the Fed was engaged in quantitative tightening, just as QE increases bank reserves, as we can see here, just as QE increases bank reserves, well, QT is the opposite. And we can see that QT is what the Fed had been trying to do leading into the repo rate crisis of 2019. It was pretty minimal, the amount they were actually able to reduce their balance sheet. They only got it from 2.15 trillion down to 1.85. Then the repo rate crisis hit. They had to increase their balance sheet. And then a month later, the events of 2020 happened and they had to print all sorts of money. Um, People have theories on that, but I'll leave that for the comment section, I guess. Here we can see that a degree of QT that has been engaged recently is much more significant than what caused the 2019 repo rate crisis, right? The Fed balance sheet has gone from 9 trillion all the way down to 6.6 trillion. So it's a much more significant amount of QT. You can see the blip. This was the regional banking crisis when they had to kind of temporarily reverse their QT. But we can see that that's had a negative impact on bank reserves. Just as QE is creating bank reserves out of thin air, depositing it to the banks, just as QE is doing that, QT does the opposite, which is reduce bank reserves. Now, remember, when you're talking about the money supply, M0 is kind of the base level. That is the monetary base. Monetary base is comprised of bank reserves that we're looking at here and currency, physical currency in circulation. And so this is kind of the base layer of the modern day money system. QE increases bank reserves, one half of the monetary base, increases bank reserves. QT does the opposite, which is decrease bank reserves. And we can see we've been in a period of QT, just like we were during the last time Trump was president, when the Fed was engaged in quantitative tightening. This is one of the reasons that the Trump Powell beef goes back kind of far. Is there were things going on in the first administration that are reminiscent of today that Trump feels a certain way about. So here is another liquidity negative or positive, depending on how you look at it. The Treasury General Account. This is a checking account that the federal government has. And so, if you think about it, if a bunch of people and businesses are paying taxes, right, that we're sending our dollars to the Treasury. It goes into the Treasury General Account, into this checking account. Well, after we send our taxes in, business individuals, we can't use that money, right? It's gone. It's in the government's hands now. So when the TGA goes up, this is indicating this is a negative for liquidity because liquidity is being sent and sterilized in this government account, not being actually used for anything. But the opposite is also true, which is when the TGA comes down, what that means is money is being spent out into the economy, right? That money that had been kind of locked up in the TGA, well, now it's out there floating around in the economy. So when the TGA comes down, that is positive for liquidity. We can see that, generally we are in a downtrend from going back to February of 2025 when the TGA was 820 billion. We're now down to 364 billion. There was a brief kind of negative negative liquidity shock, right, with tax season where the TGA went up. But generally speaking, it is significantly lower than it was just in February. But apparently it's not enough. So here we're looking at the yield curve. Here is the 30-year, the 10-year. This is the 5-year, 2-year in red. Orange is the 1 year. And finally, Yellow is the 3-month, the very, very short term bill. We can see the bonds. This is a very short term chart, only 1 minute. So, like from here to here is only 15 minutes. And what we can see is that for the vast majority of the maturities, shape, duration in the yield curve, yields actually came down on the 30th, right? So the 30-year came down ever so slightly, meaning the 30-year was getting bought. The 10-year came down, yield came down, meaning the 10-year was getting bought. Well, we can see with the short-term maturity, the 3-month, we can see it spiked higher. So just as the rest of the yield curve was getting bought, we can see that the short end was getting sold. There was a 30 basis point spike here on the 3-month bond yield on Monday. Very, very short term, right? It reversed immediately, but there was some kind of signal of a crack. We know that the Fed's standing repo facility, remember this lender of last resort, well, they haven't, no one's been using this lender of last resort standing repo facility going back all the way to 2020. Someone needed to use it here. Well, so there's clearly stresses being indicated with the fact that SOFR over Fed funds spiked 11, 12 basis points, right? Indicating the SOFR, the private market for money, the interest rate for money in the private market is spiking relative to the federal funds rate. There's clearly a stress indicated by that. And there's very clearly a stress being indicated by the standing repo facility being utilized. Because again, there's a stigma and there's a higher cost, higher interest rate to using the Fed's Fed's operation. So there's clearly a stress being indicated. What I do want to point out, I think I'd mentioned, this has occurred before at the end of 2024, at the end of quarter 3 for 2024. We also saw the SOFR Fed funds spike. So this happens from time to time, usually around the end of the quarter. But I think what's different is that this time around, we can see the end of quarter 3, there was a small usage of the standing repo facility. But this, past 2 days, what we saw is not only did the SOFR rate spike, not only SOFR relative to Fed funds, not only did that spike 11, 12 basis points, but we also saw the utilization of the lender of last resort, which is the Fed's repo operation. The two of them combined, in my opinion, see, you can't find a spike at the end of 2024 here because there was none. Just because the SOFR Fed funds rate spikes does not mean that the stresses are really that severe. As we can see, the standing repo facility was not really used at the end of 2024. Now, the end of quarter 3 of 2024, there was a small usage of the standing repo facility of about 2.5 billion. But this is 4x that amount. So the fact that this is the first time going back all the way to summer 2020 that the repo, the lender of last resort with the Fed, that it was being utilized, I think that's notable. And, the SOFR minus the Fed funds, that spiking is also notable. And then finally, when you look at it in context of what the central bank has been doing, what the Fed has been doing, which is QT, I think it makes sense, right? Liquidity, cash out in the system, dollars, we have reduced via QT, just as what led to the 2019 repo rate crisis, which no one wants to have happen again. Just as the Fed was engaged in quantitative tightening back then, we have been engaged in even more significant quantitative tightening this time around. We can see that's had a negative impact on bank reserves. So, it all kind of makes logical sense. The Fed does not want to get bank reserves too low. There is something they refer to as the lowest comfortable level of reserves. No one really knows what the lowest comfortable level of reserves is. It's just a bunch of people estimating. If you want some comedy, you can just Google that term and read them talk themselves into circles about what the level actually is. No one really knows. There is theoretically this level that they understand. Once bank reserves fall below that, it's trouble. The problem is no one really knows what that level is. But the Fed has indicated that they're tapering down this quantitative tightening that they've been engaged in. They are kind of ending that, and you can kind of see that reflected in the shape of the balance sheet. You can see that it's kind of the slope of the line is changing, and it's going from a steeper slope to kind of leveling out. So the Fed is already indicating that quantitative tightening is coming to an end. Now, just because quantitative tightening is coming to an end does not inherently mean that the only other thing they can do is quantitative easing. As we saw during the mid 2010s, the Fed was doing neither, right? They were doing neither QE nor QT. So there is a middle of the road option, which is they just do nothing. They don't do QE and they also don't do QT. It's just level. There is that middle of the road option. I think personally that the bias would be towards QE returning within the next 9 months to 12 months. We're seeing liquidity stresses, right? So for Fed funds, the use of the standing repo facility at a level not seen since the summer of 2020. We're seeing the indications of liquidity stresses. We know liquidity has been drawn down by QT. And this is only looking at these particular metrics. If you look elsewhere, you can see even more metrics. And I will finish. There is kind of a theory going around about this particular usage 2 days ago and what's really going on. But very quickly, I just want to show the 1 month yield, the 3 month yield, and the Fed funds rate. We can see the Fed funds rate is does not have gyrations to it. This is the middle of the target range that they set, and they actually, the way that they set the Fed funds rate might be interesting. If people are interested, leave a comment. I could do a video on that. Generally, though, I mean, this is a question for people. Generally, you see the 3 month yield come down before the Fed makes a cut. And this makes sense because remember, they're buying a 3 month treasury bill. So they want to lock in their yield. But, with if they believe the Fed's going to cut in the next 3 months, they want to lock in their rate sooner than the 1 month, right? Because this, you're only locking in a rate for 1 month. So generally, the 3 month yield will come down first, then the 1 month yield will come down, and we can see that going back through the Fed cutting cycle. But what we've seen here is kind of interesting to me, and I'm not really sure what's going on. Which is the 1 month yield came down much more notably than the 3 month, and it did it before the 3 month started. The 3 month did decline from 4.37 down to 4.28. But you can see that the 1 month was actually declining again, meaning the 1 month bond, 1 month bill was getting bid. The bill itself was getting bought. The yield came down before the 3 month did. So if people have an explanation for that, I would be interested. And then finally, I mentioned, there's kind of questions about this. This is from just Dario on X. He said, "Did the Fed lie yesterday? As you can see here on their own website, the total size of the June 30th repo operation was updated to 11.075 billion versus only 6 billion initially reported, and two tables with different amounts being added showed up in the records." He asks, "Is this a lie or an ugly glitch that nobody spotted or fixed for more than 5 hours? You choose, but personally, we have seen many weird things happening around here in the recent past, and it's hard for me not to feel some shenanigans are happening." Now, just Dario errs on the side of shenanigans. I think shenanigans are always more interesting to people. I'm not really sure that it was necessarily shenanigans. I think it was probably just an error. But there's clearly stresses that we're seeing starting to show up. Standing repo facility, lender of last resort, stigma, and a higher interest rate. But yet, $11.07 billion was tapped in the standing repo facility. We know SOFR is a massive market, right? Almost $3 trillion a day. We can see the SOFR rate spiked well above the Fed funds rate. And unlike other quarter end, right? A lot of people say, well, this is just quarter end normalness, right? Well, in that case, why did the standing repo get tapped, right? Like the end of the fourth quarter, it didn't get tapped. Sure, there was an increase in SOFR minus Fed funds, but the lender of last resort didn't need to get used. So I think that this is, indicating some degree of stress. Now, it's nowhere near 2019, but I think that this is just one of many indicators that QT is coming to an end. And in my view, QE will likely start back up again, and that is generally positive for asset prices across the board. So, anyways, hopefully that was helpful. If you'd like to see a video on how the Fed actually sets the Fed funds rate, I can do that. And if people have any theories or explanation for why we saw these dynamics with the 3 month and the 1 month, please leave a comment, and I will catch you in the next one.